And a good afternoon to anybody joining us on the recording of this, the first in our investment series of the Advice Gallery webinars. And for anybody watching the recording, thank you very much for tuning in. I hope you're finding these videos of some use. We will leave it another minute or so in case anybody else joins, and give me a chance to dunk my tea bag. As I mentioned, we're kicking off our investment series of the webinars. For those new to the process or that aren't quite familiar with what we're doing here, the Advice Gallery is a new financial planning business that has been set up by the team behind the Loan Gallery. And the remit we have is to provide a significant amount of useful information and education for people out there keen to learn a bit more about their financial position. Financial advice is a fairly difficult space for people to enter. It's quite expensive to get new advice. So we're trying to provide as much information as we can for free, largely using these webinars and some of the other material we're providing, to help give people access to the information they need to make really good decisions for themselves and for their financial future. We have done a series on kind of what financial planning actually is, what we do, how it works. We've done another series on cash flow management, so budgeting, how to allocate money, why you should bother doing it. And the recurring theme for all of that has been be intentional with your money. One of my not even pet peeves is just worries is when I see people that are just living their financial life in line with what everybody else is doing. And I know everybody's life is so different. So I really encourage people to be intentional about their money. We've just wrapped up our insurance series. That didn't get a lot of viewers, which wasn't too surprising. It is a fairly dry topic, but I have had a lot of feedback. We use it now when we're bringing clients on for insurance advice or helping people answer insurance questions. Being able to refer to the material we've recorded, we've had some really good feedback on that, which has been nice. And now we're heading into the investment series. So there are 4 to 5 episodes planned for this series, starting with today's one, which is all about the fundamentals of investment. And we'll explore some of the tips and traps and some of the know-how that people should have as they embark on their investment journey. Every working Australian has some investment exposure through their superannuation. Every person that owns their home has some exposure to an investment of sorts through real estate. And I think it's incumbent on all of us to know as much as we can about investing so we can make those really well-informed decisions. Okay, all that being said, we shall hop in. I noticed that there's quite the flicker of light going on behind me. Hopefully that is not coming through in the recording. Okay, let's hop into our presentation. Wonderful. So what we're talking about today are the fundamentals of investing. I think there is, in all the people I've spoken to in my career, they kind of fall into 2 camps. There's people that are really comfortable with investing, and somewhere along the journey before I've met them, they've had an introduction to investment. Maybe it's from their parents, their family, work colleagues, a mentor, something like that. It makes sense to them. Then there's everybody else for whom investing can seem a little bit confronting, a little bit challenging, a little bit intimidating, and a little bit unsure because it has its own language. And I want to explore that a little bit today, some of the language to try to give you that information, kind of arm you a little bit with the knowledge so you can help, to help you start off investing in a really sensible, useful way for your own needs. So we're talking about the fundamentals. Now, as ever, we have we have a theme today. The theme is gardening. Always like gardening. So our theme, because I think investing well and investing properly is very akin to gardening. Patience is rewarded in gardening. Organization is rewarded in gardening. Structure, consistency, sustainability are all really good features to have in gardening. But also sometimes you can just get knocked around by nature and by things that are completely out of your control, which speaks very much to investing. So there are often parts of gardening that are about mitigating and avoiding risks where possible, which I think dovetails quite well into a discussion about investments. The disclaimers, everything we're talking about today is very general in nature. We don't touch on anything too specific today. This glasses and I don't wear glasses. I wear glasses now. I haven't previously. I'm still getting used to them. So we're not covering any really specific information here. It's very general in nature. I don't know your circumstances. Please don't do anything based on what I talk about in this video. Seek out professional advice before you make any big decisions. And this is being recorded. Okay, so let's start at the very beginning. I won't make the soil metaphor there, but we are starting at the very beginning. Let's talk about the fundamentals of investments. So I think what can happen sometimes is people can get really enthusiastic about the tactics or the mechanics of investing. You know, what's the great cryptocurrency boom looking like? What's the fantastic real estate investment that I've been told about? What's this great, fantastic uranium share? And I think I can see why they're all very exciting, because it's like knowing about a winning horse in a race. But what I encourage people to do is ignore the shiny, noisy bit, take a step back and actually think about the fundamentals. And a lot of that is actually, what is investing? How does it differ to other approaches with money? Why should you even bother investing? I mean, these are pretty basic questions, right? I mean, most people just assume that they're going to start investing, but why? What's the reason for it? We'll explore a lot of the jargon, or not jargon, the terminology that people like me use when we're discussing investments. And we are going to finish off with a brief discussion of what is known as the free lunch in investing, or compounding, which is, depending on the source you trust, has been quoted as one of the sixth wonder of the world. Let's start with the basics. What is investing? Very, very simply, it is putting money to work for a period of time in assets with the expectation of positive returns. So there's a few things I've underlined there, as you can see. Firstly, it's for a period of time. Every investment will have an entry and an exit. And the best investments for the person making the investment will have a planned entry and a planned exit. If either of them are unplanned, you're giving yourself a greater chance of being disrupted or disturbed down the track. So I think it's really important you notice it's for a period of time. So superannuation is a really good example here. You will have investments within your superannuation, and the period of time that you're investing for will directly influence the best investments for you at the time. So if you're a 22-year-old person starting out in their employment, they're going to be working for the next 40-odd years, 45 years, you can absorb a different risk profile in your investments. So you'll have a different investment makeup, but you know that you're investing for that period of time. If, however, you're a 50-year-old person investing outside of super for a few years, that also changes the dynamic of the investments. It's also important to note that investing involves putting money into assets. So paying off your home loan faster is not, strictly speaking, an investment. Putting money into something like cryptocurrency, I'm not going to bash crypto in this, but that is not really a financial asset as such. It is a speculative instrument. So you're putting today's money, spare money, excess money into an asset with the expectation that that will grow in return. Now, the expectation is a really interesting component underlying investment, and we'll talk about risk and return down the track. But essentially, you're making this investment not knowing what the future is going to do. So all you can do is make your best guess and have your best expectation of what will happen. So you pick the investment that has the greatest likelihood of providing you with a level of return that aligns with what you need it to do. So there are some people that do it, but most people don't put money into an asset hoping it'll go down or that they think it'll go down. So it is that expectation. This is where you get, in economics and in the markets, we measure things like sentiment. That kind of correlates to expectation. If your sentiment is really low, your expectations are going to change as well. So that's what investing is. Maybe overcomplicated, because I think for most people it's just putting extra money aside. But it's also working out how long is that money being put aside for, where will it be being put, and what is your expectation of how that'll perform. So we've talked about those returns, those positive returns. They can come in the form of income or growth. And we will expand on this a little bit later in the presentation, because every investment, every asset, every holding has very different characteristics in a number of different areas. And one of them is in the nature of the returns, be it income or growth. Another one is in the level of risk involved. Another one is in the taxation that's required. Another one is in the diversification benefits it offers. So each investment is unique, and the way it contributes to your portfolio needs to be considered as well. So in terms of fundamentals as well, who actually invests? The bottom line is everybody. As I mentioned, every working Australian has some investment held through their super fund, and every person that owns their home, be it via a mortgage or outright, they're also invested in a market of sorts. They are in an asset for a period of time, and most people, you would think, have the expectation of a positive return. Now, I have limited those returns here in the form of income or growth, but there is also a positive return that comes with owning your own home, which is residential security. So an intangible and unquantifiable positive. More specifically, though, the people that are actively investing and that are looking at making investment decisions are people who have excess cash flow, so they can afford to put money towards something, or they have a lump sum of money greater than their needs today. Frequently, we see that through perhaps an inheritance, a divorce, redundancy, lump sums that come in. They also need to be looking to put that money to use, and crucially, they are comfortable accepting the risks that are involved and putting money aside in the expectation that things will be positive. Because it is worth pointing out that it is the expectation, not the guarantee, of positive returns. Investments will turn negative. Every investment that exists has the potential of going negative at some stage. So you need to be comfortable accepting the risk and the likelihood of that happening and the impact of what that would look like. And refer to some of the previous episodes of the webinar series where I talk about risk as that relationship between likelihood and impact. So for anybody that's in those categories, they're the people that are investing will tick any three of those characteristics there before they start their investment journey. So the reason I'm putting this in here is we see some people that are like, I need to buy an investment property. My brother-in-law's got one. My friend has one. They were talking about, I want to buy an investment property. And then one of the first checks we will do, the first thing we'll say is why. The second thing we'll say, okay, do you meet kind of this criteria? And yeah, we meet people that don't have excess cash flow. They don't have money put aside. They don't have a lump sum they can put towards it. And they're not fully aware of the risks they're being asked to accept. So we can come across as a bit of a downer sometimes by asking these questions. But I think it's really important that as an investor, you're going in and making really well-informed, comprehensive, and intentional decisions. When do people do it? Lots of different timing. Like I say, when you start your employment, you are investing in some form or another via the superannuation contributions. All of the other assets, people kind of invest in different times of their life. So most people will have a savings account, and an indicator of good financial education as a child is if you have a savings account and a savings habit. So if you count savings as an investment, some people start doing that at a very young age. Superannuation starts when you join the workforce. Property tends to come later in life when people have been able to save up a deposit. And property there as well has that interesting distinction between a personal place of residence, which has positive returns beyond growth and income, and investment properties, which have their own characteristics as well. And then finally, shares. Typically, what tends to happen is through the life cycle is people save money as a child, join the workforce, and they add superannuation to their investment journey. They purchase a property along the way. The property is paid off to a fair extent, and then they're either looking to buy another property or start investing in shares. In my experience, kind of the minority of people head down the share pathway. A lot of people head down the investment property pathway, and then that's how they start accumulating that investment know-how. If I'm pushing back on that kind of momentum of that journey, along the way, there aren't a lot of intentional decisions. It's often a matter of, okay, well, I've paid off my residential home. I want to buy an investment property. Tell me how I do it. So we get engaged along the way, and so do mortgage brokers and conveyancers and buyers advocates and all the people involved to help people learn or show them how to do it. What is asked infrequently, and is something that we do quite a lot of, is taking a step back and saying, why are we doing it? Why is this the next step of your investment journey? And it goes back to that idea of being really intentional about your money. Regardless of that, with any investment strategy and any investment structure, in my opinion, and this is supported by the research, it is more important to be consistent in a small way than time it in a big way. It is far better to put $1,000 a year into an investment than to drop $10,000 up front and just hope it goes well. It's far better to it's like exercise. Doing a little bit every day is far more beneficial than doing a huge amount on a Saturday. Investing is very similar. Even with gardening, it's better to do a little bit of weeding every day than have to do it once a year, and then you've just got bags of little beads building up. How do people do it? We will talk a little bit more about asset types and allocations in future webinars, but broadly speaking, there are a range of different asset types that people can invest in. So you go from cash, term deposits, bonds, international bonds, through to property units, shares, international shares, hedge funds, and a whole spectrum of investment types. Now, that spectrum tends to fall along a risk axis. So very, very low risk through to very, very high risk. All those assets have their own different contribution types. So you can buy them outright as a lump sum. You can finance into it using debt. You can use regular contributions to go towards it, or regular investments to build up the balance. There's a whole range of things you can do it. There are those lump sum and versus ongoing options. And then you've also got different ownership structures. So I often think of owning your own business as an investment of sorts, because it needs to operate as a standalone investment. There will be an ownership structure that people use to own that. Different options as well. You've got superannuation as an ownership structure too. And then you've got owning things personally, owning things in joint names, owning things as a partnership. Different ownership structures have different characteristics when it comes to investing. And even as I'm saying all of this, I can see the complexity that just comes into this process that can intimidate people away from investing. I'd like to interrupt the process here and just say investing is invariably, in my experience, I can't think of a counter case actually. Investing is a good thing. Putting today's money aside for tomorrow is inevitably a positive thing to have done. All this complexity we add to the process, they're just puzzle pieces that need to be rearranged to make the picture work for you. But the actual act of investing, I encourage everybody to do it. In saying that, why do we bother? Why bother investing? Because today's sacrifice, today's investment are the same thing. You're taking $100 out of your pocket today and you're putting it aside and not touching it in the hopes that that'll be worth more in the future. By doing that, you're taking $100 out of your capacity to enjoy life today. And I'm working with somebody at the moment where they are really struggling with this. They're about to inherit a large amount of money, and they have not had much money in their life, and they really want to spend it all. 6 figures, they want to spend it this year. But part of them is wrestling with that because they know that future them will regret that. And they are really trying to ask me, why should I sacrifice? Why should I do this? So we talk to the benefits around the nature of investing. And these work at an quantifiable or even intellectual level. We know that these things are right. But again, to return to gardening, we know that gardening, weeding every week and planting every fortnight and managing the water, we know all of these things are the right things to do, but we don't always do them. And when we don't always do them, we don't get the outcome that we're looking for. So in terms of the benefits of investing, one of them is lazy growth. Money you put aside in an appropriate investment will just sit there and will just accumulate over a long period of time. I spoke to somebody today who had set up their superannuation account in a particular investment style, growth I think it was, 20 years ago, and haven't looked at it since. It's now averaged 11% a year return for them over that period of time. At the same time, I see people that stuff around with their super every year, they don't get 11% a year. So just being lazy and letting it grow and accumulate over time is a wonderful strategy. It gives you confidence in your financial future. So it gives you confidence that the money you're putting aside is going towards an unknown and uncertain future, because we don't know what the future is going to look like. Everybody watching this, I think, everybody watching this will have grown up in a world better than it was 100 years ago and 50 years ago. We live, despite all the news and all the negativity that is around, and it's not phantom, it is there. Our life and our world is generally more secure, more positive, more confident than previous generations. There's no reason for that to always be the case. We do not know what the future will hold. So putting money aside and will help you build confidence as you're facing an uncertain future. It also brings, and this is a very boring benefit, this is very unappealing to a lot of people, it gives you responsibility for your own money. It gives you that feeling of layered is probably the best term, responsibility, because every positive habit, every positive step you're making, every positive action you're taking with your investments and with your money is breeding a feeling of responsibility about managing your own money. You may know people that feel like they're just across their money. They just get it. They're the people you look up to when you think about doing money really well. This is often how they got there, by working on those different elements that bring layers of responsibility to their life. The final one is wealth. Wealth is freedom. Wealth is independence. Wealth is control. Wealth is positive. Wealth is an early retirement. Wealth is a well-paid off house. Wealth is the time to have the ability to pay for the time that you want to spend with your children and your family. Building wealth comes by investing. It doesn't happen by accident. Um, some people think investing in a Tassilo ticket is an investment. Maybe it is in a way, but the odds are very, very low. Real wealth is built by doing small things consistently and regularly. There are costs. It requires discipline. It requires taking money out of your day-to-day cash flow and putting it towards something. It requires discipline with making decisions around money. It requires discipline around making selections of investments. You can get around a lot of this by building habits and structures to automate it as much as possible, which is where superannuation is a really good example. You have, I think it's now, as of today, 12% of your salary going towards your superannuation. Maybe it's 11. That's an out of sight, out of mind kind of thing that's helping you build an investment portfolio. There's the fear of missing out. That $100 that you're putting into your investment every week, that's $100 you're missing out from spending going out to do something or seeing people or having fun activities. Feeds into that discipline idea. So pretty risky and uncomfortable. The idea of putting $1,000, $10,000, $100,000, $1 million into an investment requires accepting a level of risk that money may become, 900, 9,000, 99,000, 900,000. And that's very uncomfortable for people, understandably. There's also a discomfort that comes with confronting the way we think about money. So some people have been raised to think that good people don't invest. There is a range of different money mindsets out there, and that's one of them that can be quite damaging. So if you are investing, therefore you are not a good person. So to be a good person, do not invest. That's a very confronting thing to challenge. The idea of putting money aside can challenge people's identity, can challenge people's approach to life. Money is a very weighty topic for a lot of people. Those costs are expensive, but the benefits, I think, outweigh it. So let's move from there, while I have a sip of my tea, to the terminology and jargon that is used in the investment world. I'll try to keep things here really high level, but also fundamental, because if you can understand these terms, it's going to make investment decisions a lot easier and a lot more sensible for you too. First big one, and this is me echoing the same topic that I've echoed through this whole series, is being intentional with your money. Have goals that you're working towards, have milestones you track along to, but have a destination that you're working towards. That is then your guiding light when it comes to making decisions about money. So to flash back to those people I mentioned earlier who said I have to buy an investment property, quite often it's so they can have a passive source of income later in life. But when we run the numbers, to do that is going to require them to keep working till they're 67 and diverting a large amount of their money towards paying down that debt. Now, if that's okay with them, if their destination is to accumulate multiple properties and multiple sources of income to build generational wealth, wonderful, let's go down that path. But if their intention is to stop working at 55 and retire early, that's their destination, then that doesn't align. So buying the investment property is an unintentional step towards a destination they don't have. So we spend a lot of time with people unpacking their goals and intentions to make sure they align with where they're actually heading. And this is what feeds into all of the investment decisions. So if you ever ask a financial planner, is this a good investment? Every financial planner worth their salt will say to you, it depends, because it all depends. Gardening, if your ideal garden is an English cottage garden filled with flowers and bees and insects and structure, and it's lovely, then you don't plant a stack of cacti. You don't plant a stack of vegetables. You plant a type of plant and you garden a type of way to help you achieve that destination, to achieve that objective. Investing is very similar. So set a destination, follow the steps, track the progress, and be very deliberate in what you're doing with your money. Another one is risk and return, and it is worth highlighting. This is an unbreakable bond. I think we can break the bonds within atoms. This is stronger than that. This is an unbreakable bond. There is no way to get around this. Higher return must equal higher risk. Lower risk must equal lower return. You cannot get around this. Low risk and high return do not exist. Beware of anybody telling you that they do. Beware of any social media ads that are telling you they do. Beware of any friends or family that tell you they have a very low risk investment that is shooting the lights out. They do not exist. And they do not exist for one very, very simple reason. To get a high return, you need to take on a high level of risk. So I have $1,000 and I want to get the highest return possible. I have three investment options. Option A, it's very low risk, very safe, very good chance I'll get the money back. So the people on the other side of that deal are going to say, look, this is a secure investment. Why would we pay you extra money? Okay, you're not going to lose money on this. We'll pay you the rate of return that reflects that. The middle one is, look, it's going to be pretty bumpy. So we'll pay you a slightly higher rate of return to compensate you for taking on that extra risk. The third one will say, we are going to give you the highest return possible, but you need to accept the chance that your money won't be there. We want you to give us this money, so in return, we will compensate you by paying you a higher rate of return. There is no scenario where somebody's going to say, look, I'll give you an investment that doesn't have much risk. You're guaranteed of getting the money back. And in return, I'll pay you way more than I need to. That's just not the way human interest works. With every single investment, you are taking on an element of risk, a risk of loss, a risk of liquidity, a risk of volatility, a risk of timing. All of these risks apply, as with life. In doing so, in taking on that risk, you need to be compensated via a level of return that matches that level of risk. This is why term deposits will have a very, very low rate of interest compared to a speculative mining company. It's just how it works, and we cannot get around it. It cannot be broken, and anybody telling you that it can, find out why they're telling you that. Diversification is a really common one. It's a really big part of it. There's a whole academic theory behind it. Essentially what it is, the old don't put all your eggs in one basket, which is just this throwaway line I think we always use. But if you think about it, the thing is, though, everybody that farms chickens or has chickens at home, they all use the one basket. So it's funny. But the idea is that if you have one basket and all your eggs in that, if you drop that basket or that basket breaks, you lose all your eggs. So you don't want to put all your eggs in that basket. You want to have multiple baskets that you're carrying the eggs along with. The way it relates to investments is you mix a variety of investments within a portfolio to reduce the overall portfolio risk. So a gardening equivalent would be having a vegetable patch. You wouldn't plant all the same plant all at the same time. Because if you had a storm come through, if you had a bug infestation, it's going to destroy that plant. A far more sensible approach to try to maximize the yield of that plant bed is to have a diversity of plants in there. They will generally grow better, they will generally be healthier, and they'll generally be more resistant to different events occurring. With investments, every investment, as I said, has a particular level of risk. Now, if one is a 90% risk and one is a 30% risk, what you would do in a diversified portfolio is you would combine them in such a way that the overall risk is lower. So instead of it being sort of a 90 peak risk, it might be a 40 or a 50 level of risk across the portfolio, because the low risk one is diluting the risk of the higher risk one. The upside of that is that your lows, your bottom returns, shouldn't be as low as a general person investing in the one single asset. The downside is that your overall highs will not be as high as the person that lands a winner. So somebody invests in, I don't know, somebody had put all their money in Fortescue 20 years ago, 15 years ago. They would now be sitting in a very, very, very fortunate position financially. Your average diversified portfolio will not have returned as high as that did. If somebody had invested in, I think Anaconda was the company he was in before that crashed and died, burned. So they lost all their money. Again, a diversified portfolio would not have that exposure. You'll have more of the winners, but also more of the losers in a portfolio of diversified investments. The overall level of risk for the overall level of return This is the closest thing we have come to breaking that nexus between risk and return. So it's just spreading the money around. So you can diversify across asset classes. So I mentioned that spectrum before. You've got cash, term deposits, bonds, property, etc. You can diversify by having some money in each one of those pots. You can diversify money by having money within different asset classes. So in property, if you have the funds, you could have a residential property in a house, a residential property in an apartment, a commercial property as a factory, property units via on listed property companies. That is a level of diversification within the asset class. You could have different styles of shares as well. Beyond asset classes, you could also have a share portfolio that's made up of international shares that are investing in different market sectors. So you're spreading the risk across more and more investments, trying to give yourself the best chance of avoiding the losers, but also picking the winners along the way. Diversification is a really powerful tool. It's a fundamental tenet of investing in the modern world. And one of the things we see with people buying properties is they tend not to diversify. So they'll have 3 or 4 investment properties in the same state, same city, same suburb, even the same estate. I'm seeing people with multiple investment properties. And yeah, it might work, but it's a level of risk I'm not always very comfortable. Income and growth. So we've talked about this, the different components of an investment that are making up those positive returns. Income is that investment income you receive regularly from your investments. So dividends, interest payments, or rental income. It's paid from the body of the investment, it's paid to you personally. So it shouldn't come off the value of the investment. It's just paid to you as an offshoot almost. Think picking tomatoes off a tomato plant. The tomato is the income, the plant itself is the investment. As long as that keeps growing, then you can keep taking those tomatoes off without affecting the value of the plant itself. Growth, on the other hand, is focusing on increasing the value of your investments over time. So instead of getting regular income, you're leaving those tomatoes to keep growing on the vine. It's not really working. But also you're concentrating more on how the tomato plant is growing. Is it becoming bigger? Is it becoming higher yielding? Is it generating better fruit of a more frequent and more bountiful quality? You're focusing on the plant itself rather than the yield that you can take off it. Liquidity is a really important consideration, and particularly for property investors. I'm kind of ragging on property investors. I'm not meaning to, because a lot of money is being made across property, particularly in Melbourne and Sydney. But I want to encourage people to be really intentional about the pros and cons of investing in property. And one of the downsides is that they're not very liquid. So liquidity is how easy it is to convert an investment into ready cash without affecting its market price. So if you have an investment property, it's worth $500,000, but you need 50 grand. You can't sell a bedroom. You either sell it, the whole thing, or you keep it. Now, if you're selling the whole thing because you're in desperate need of 50 grand, you will have to discount the price to get the value, to get the money quickly. The faster you need the money, the greater the discount you're going to have to apply to the sale price. So that's where they're talking about affecting the market price. Diversification can be a factor here. If you're diversified, you should have access to cash and liquid investments, so you don't have to sell down a property and take a discount or take a hit on the price when you sell it. Liquidity is critical. If you are buying an investment property and you have no liquid cash, be very, very, very careful. Saving, investing, and speculating. There's 3 different kind of sides of the equation. Saving and investing are different. Saving is putting money aside for a rainy day. You're just putting your money away somewhere where it's safe, low interest, low risk, low return, because the goal is to preserve cash, ready cash, liquid cash, without taking on significant risk, because you will need that money at some stage. For some people, it's hitting their rainy day figure and just knowing they've got the money put aside. For other people, working with somebody, they intend to return to school to study, full-time study in a couple of years. There's no point investing that portion of their money. It should sit there in cash. We accept that there's going to be a low return on that, but it's liquid and available. They've saved that money. This is very different to investing. I've brought back the tomato metaphor. Investing is growing something, putting capital into assets with that idea of bringing the money out to bring you closer to achieving your goals. True investors are very intentional, they're very informed, and they're very deliberate in what they're doing. They know what a satisfactory return is and what they're pursuing, and they are intentional about their approach to that investment. They do not become attached to investments. They do not become emotionally invested in their investments. The investments are a tool to bring them closer to achieving their goals, which is why goals and intention are so important in our process. In terms of time frame, most investors will hold an asset for at least a year because they know that they're in it for the longer run, because they want to see those things appreciate over time. Speculation is breaking all of these rules. Speculation is putting all of your money into essentially one fruit, one basket, one asset, and hoping that you hit it big. So if you think of a classic speculator as someone going to a gold rush, they're panning in the river and they're trying to hoping they find that big nugget. They're speculating on the prospects of getting that big nugget. If they get that big nugget, their life will change. But if, as is more likely, they don't, their life will suffer. So it is much really risky. It's far closer to gambling. I toyed with putting a roulette wheel in that image instead of an unripe tomato. You're betting on that asset hitting big. You're betting on your number coming up. You're focusing on short-term price fluctuations and you're hoping to capture a rapid gain. They're looking for that one big win rather than making gradual improvements. So cryptocurrency is a really big example of this. Cryptocurrency is a speculative interest, in my perspective. You are buying that thing in the hope that that will land and hit it big. You're not buying that thing to hold it for 20 years and generate a steady level of income and a regular rate of growth. You're buying that to hit it big. It's very different, though. Saving, investing, and speculating are all very different. Now, let's pop over to compounding. How are we doing for time? Okay, good. As I mentioned, compounding has been described as the sixth wonder of the world. It has been described as the closest thing. I've just mixed my metaphors. This is not the free lunch. Diversification is the free lunch. Compounding is the sixth wonder of the world. So ignore the free lunch references. That's embarrassing. Compounding is it's earning money on money. So it's where you earn interest on the interest you've already earned. So essentially you have an investment, it's generating an income return, you keep that in the investment. So then the next time that income return as a percentage is being multiplied to a larger amount. You can also do that with growth. So if your investment of $1,000 grows at 10%, next year you've got $1,100 to grow at whatever rate of return it is. If it's 10% again, the following year you've earned 10% of $1,000 plus 10% of $100. And it sounds like nothing and it looks like nothing. It's a really tiny thing. But you'll see that interest on interest, given a long enough runway, becomes exponentially powerful. And that's where that sixth wonder kicks in, because you're suddenly earning money on top of money on top of money on top of, and it just keeps growing and spiraling upwards. So what you need to really take advantage of the benefits of compounding and the power of compounding is you need to start with an initial capital amount. You have the option then of putting in ongoing contributions. And this is what we're talking about with super. Super starts with an initial amount, and then you start pumping money in on a regular basis. Pardon me. You also need to allow time. So much time. Lots and lots of time, which also means that you need to have patience. This is not a get-rich-quick scheme. This is a get-rich-slow scheme. You will be bored. You will be uninspired. You will be frustrated. You will be impatient as you're watching this money very slowly grow, slowly grow, slowly grow. So superannuation is the best example I can think of. You start working and you get $1,000 in there. You get $5,000 in there. It's not really doing anything. You're seeing these big returns, but not doing anything. Then you got 10,000, then 30,000, then 70,000, then 120,000. And all of a sudden it starts really accelerating. So you've got 500,000 earning 10%. So you've got 550 the next year. And then 605. And then 670. And then it just keeps climbing. So what you really want to do is be in there long enough to ride out the flat bit and then be there for the curve, be there for the boom. So I'll show you some examples around this. So an investment of $10,000 at 5% a year, we're ignoring tax, we're ignoring fees. It's just a straightforward 10 grand at 5% for 5 years. You end up somewhere around 12.5 grand. If you're just sitting there making 5% a year, cool. Go to 10 years and you start to see the slope increase a little bit. This is where we're getting that exponential benefit of money on money on money on money. So after 10 years, you're closer to $17,000. If you were on a nominal interest where you're taking the interest out every year, you would just be sitting at 10 grand. However, at 50 years, which sounds extraordinarily long, but if you're an 18-year-old person joining the workforce now, that gets you to the age of 68, which is retirement. You're touching $120,000 after 50 years without having done anything, essentially. You just need to be getting 5% a year for 50 years. You make that 6%, you make that 10%, that probably gets a lot steeper and those numbers on the left get a lot bigger. But what you don't want is you don't want to be selling out around sort of year 15 or year 19, because then you're missing all this uplift. Now, the next example I want to show you shows what does it look like if you're putting money in as well. So you see the curve there at 50 years, you land a bit short of 120 grand. Now, if instead you put $10,000 in today and you're putting $1,000 in every year, so 90 odd bucks a month, and you did that for 50 years, this is essentially superannuation, all of a sudden you're up closer to 320,000. And over that time, you've put in 50 grand extra, you've put in a total of 60 grand. And that's just that power of that inertia that comes with growth. Maybe more of a snowball. It just grows and grows. If you can avoid touching it, if you can leave it alone for that period of time, that's how it'll play out. Now, we shall call it there. That is investing as a fundamental exercise. Investing is a critical part of taking control of your financial life. It's very complex. People like me and people in my world, we benefit from the complexity, because if you don't understand it, you need a guide like us to take you through it. But I hope in this presentation, I've been able to distill it down and show you a few of the key fundamental factors you should be aware of when it comes to investing, and how, all of this hinges on what are you doing it for? What's your light on the hill, your North Star, your goal? What's your objective with investing? Not, what do your mum and dad say? What does my brother-in-law say? What does my mate down the pub do? What's your reason for investing? What are you trying to achieve? Everything else flows on from that. That's the final takeaway I would leave you with. On that note, if you do have any questions, if you want to talk about this stuff at all, please feel free to give me a call. There's a link on the website to book in a call for a time. I'll give you a ring at a time that's convenient for you. And as of today, 2nd of July, we are continuing our limited promotion of waiving all of our advice fees for any new clients that are related through Metricon or the Loan Gallery. So please get in touch. More than happy to help in any way we can. I love talking about stuff, as you can tell. So let's have a chat. Thanks very much.